Hi everyone, so we're going to be looking at currencies today. So right now what you guys are witnessing is the unwind of the cycle. So this is a perfect time to start learning how the cycle actually works, right? Because we're actually heading into a recession, and this will be one of the hardest periods you'll ever have to trade through. Recessionary periods, and I'm not saying it's going to happen tomorrow or next week, but the writing's on the wall that we're now preparing for it. The economy's starting to roll over, and you'll see certainly from the PDF all the indicators that are telling us that there's a slowdown underway. And this is a very difficult period to trade because you need to be net short all the time, which entails us to be very tactical. Now, in that environment, there's an awful lot of monetary policy volatility. It goes up and it goes down, it goes all over the place, and sometimes currencies get stretched a little bit too far. And so looking at all the data from the United States, there's definitely a slowdown happening. And in that environment, we should see a transition of monetary policy from hawkish to slightly dovish. Something needs to break. We know the real estate market is breaking, and as you'll see from the PDF, that's all remains true. The real estate market is tit for tat right now. It's in free fall in some areas, and if you even just look at the lumber price, lumber is a massive input for real estate. If you look at the lumber prices, it tells you everything you need to know about the industry. So if lumber is crashing, the demand is crashing. If demand is crashing, it means that house prices follow after. And if house prices start to crash lower, what does that mean for the consumer? Right? It's destruction of wealth. And so the cycle comes to an end, and that's where we're at right now. So there is going to be volatility. We got shaken out of the British pound. We got caught off guard by a running flat, which ended the 5 waves up we had seen had been a C wave, and I rolled over. We got stopped out. Now, how we get stopped out matters, right? So we should only be risking a small fraction of our portfolio, really small fraction of our portfolio. And in that environment, because we got stopped out, it shouldn't damage us. So when we get one trade right, like we did with Facebook, and we make a 4-to-1 risk to reward, that pays for 4 trades, 4 bad trades. And you'll go through periods where every single trade is correct and your returns are phenomenal, and then you'll go through periods where you're pretty flat to slightly down. And so since we started Macro Insights, we've had one good winner, and the S&P 500 is paying also, and I've added in a couple of losers, and I've ignored some of the winners from TradingView, right? So what we have is we started from an unfair advantage, and the reason I want to do that is I want to show you guys that over time, it's not about this week, it's not about next week, it's about where you're going to be in a year's time, because creating wealth over time is a lot easier than fantasizing over what happened last week or what's going to happen next week, right? As long as we stick to the process and we continue to do what we do in a systematic manner, everything works out fine. Understanding the environment we're in is very important, and now you're starting to understand that growth is slowing for real, and we should be now being very tactical, and we shouldn't be holding anything with the expectation of holding it for several years. This is not the time to do it, and so we need to be very careful. So when I look at the Australian dollar, what's the next thing that happens in the United States? Convergent monetary policy. As I said, you'll see from the PDFs, the United States is in big slowdown. And so it's not necessarily what happens to the Australian dollar, it's what happens to the US dollar. And if the US dollar falls, it provides a floor underneath the price of commodities, and that'll help the Australian dollar and any inflation sensitive asset. And so when I look at this chart, I'm still of the impression that this is going higher. So as you guys can see, this is a bear flag. There's absolutely no denying that. Big picture, this is a bear flag. We started the rally here for whatever it may be back in 2016. So I think it's an A, a B, a C to complete W. Then we're in an A, B, C. We're back at the bottom of the trend here. Massive RSI divergence. And I think next week is going to be key. It'll be very interesting to see how the markets open and trade throughout the week next week. So how I'm counting this is actually this is a running flat, right? So you guys, everyone that's done the tutorial on Elliott Wave, you know what a running flat is. So running flat here for wave 2, 1, 2, 3, 4, 5 down here to complete off 3, small triangle for a wave 4, and then we drop into that final 5th wave right into support. This support is in line with the upward trend channel, and that should be wave 5 of C of X complete with nice RSI divergence, right? So this looks like we're going to put a low in here soon, and we're going to reverse to the upside. So that's the Australian dollar. We should be certainly watching this closely. I think there could be a tradable opportunity very soon. And as I said, I think this can trade all the way up to 84 once we get that reversal in. It was very clear that this sideways consolidation was not ready to rip higher. and so we were very patient in that. Now we got our RSI divergence, and the whole pattern looks to be playing out. If this is correct, it should be complete. If this is incorrect, this is an ABC that completed here, and then we've got a wave 1, a wave 2, 3, and we still have a wave 4, which should come back up to 0.77. So even if we're wrong, the risk to reward that we lose money on this, or the probability that we lose money on this, would be rather low. And the reason being is because we would know this breaks up in 3, and it would probably retrace to the prior degree wave 4. And so we've got a high probability opportunity here to get in low risk, but do wait for a reversal. You'll see this trend across the board with all the assets. It looks like we are pretty stretched across the board with currencies. So we'll move on to the next one, which is the euro. And look where we are on the euro right now. We fell out of a triangle. Triangles typically happen for a wave 4, and after a wave 4 you get a wave 5, and then you start to see a reversal in the opposite direction. I'm counting this as an A, a B, and this is all of C with 1, 2, 3, triangle for 4, and a wave 5. Characteristics perfect for an ABCDE triangle here, and then we broke down. We were very aware that we were ready to break down, and look where we are in terms of support. So look where we stopped dead last week, right on this support zone. So this is a very, very, very key area. If we break any lower than here, it cannot stay down there for too long. We need to start pushing higher. The RSI divergence on the daily is massive. So all these currencies should be on our watch list right now. We should be watching these very closely for some sort of reversal or some sort of sign that we're starting to see a little bit of strength. So over the next week, this will be a very crucial focus area. The euro, the Australian dollar, these sort of trades, they're all starting to line up. And although we got stopped out of the British pound, what we should be doing right now is not be discouraged, but waiting for a reversal. Remember, we lost a small fraction of money, and we're expecting to make 3 or 4 times that with every winner, right? So if you think about it, our thesis is not wrong. We just mistimed it, and now we might have a better opportunity. So to prevent ourselves from losing too much money or getting in at the wrong area, what we should do now is wait for a reversal. Wait for a couple of days of strength, maybe lower time frames, even in as far as the 15-minute. Look for some sort of 5-wave pattern up here to give us some sort of indication that a low is in, and we can add slowly to that position. We don't have to go all in guns blazing and add a full position on that. So the euro and the Australian dollar both are in key areas that need to hold, and always when everybody talks about this perfect head and shoulders and all this sort of stuff happening, they never play out. And all I can hear right now is how great this head and shoulders looks. And as I said, we've got a pattern here that says a final 5th wave is in, sitting on support with RSI divergence, and I would rather be on the opposite side of that trade with DSI sentiment at 87, right? So the boat is pretty much stacked on one side. DSI sentiment is for dollar at 87, so it's very stretched, it's very outdone, and at the same time you're starting to hear everybody call for this head and shoulders to break down. I think this is going to be a false breakdown, that's my own personal view. So let's see what happens early in the week. No position yet, but this could be a fantastic winner. Ultimately, when this starts to move higher, I'm expecting a move up to 130, even higher than 130 eventually, but let's be conservative and say 130, which is way higher than where we are right now, well over 10%. So that's my view. What is the catalyst? Probably some sort of agreement with China. When you look at emerging markets and you look at the state of the US economy now, you're starting to see the damage seep in, and eventually that becomes an issue when your year-over-year rate of change in tax receipts is now negative, right? So something has to change. Federal Reserve might have to monetize that debt, or they have to do a deal with China. So either the Federal Reserve come out with convergent monetary policy, or this trade war goes away. Take your pick, but in both circumstances the dollar would actually start to roll over, and that's my expectation. So next we got the British pound, which when cut straight through the 61.8 hit my stop loss anyway. You guys might have got in at different areas and went through it before it closed right above it. Very, very, very frustrating. What worries me about this is the RSI has actually gone below 30, right? So there's no divergence here anymore. We got stopped out, and I'm okay to take my position off the table on this and sit tight. This pattern is very similar to what I expect from the euro. I'm expecting this to trade all the way up to 152. So we can miss the first start of the move. As long as we get a high probability 5 waves up, 3-wave pullback, we'll buy that 3-wave pullback, and then we'll sit tight from there, and we'll cash the checks once it comes. But right now, I never, ever, ever encourage people to buy into a position straight after they sold it. And for me, certainly I got stopped out of this, and I wouldn't get straight back into it right away what I'd like to see is some sort of confirmation that a low might be in, and that would be from lower time frames, 15 minute, 30 minute, 1 hour. I'd like to see 5 waves up, 3 wave pull back into the 61.8% Fibonacci, and then we're off to the races. That would be a high probability event that the low is in. I think we're getting closer to it, and as I said, read over the PDF, the United States, you'll see that the economy is weakening. And this is as I keep going back to it, this is the perfect time for you guys to take this course, because you are now entering the most difficult phase as a trader, and you need to understand how to manage that risk. The person that gets to the end of this with the least amount of damage in a recession wins, right? Because you can buy whatever you want, and you have that mean reversion where it's several 100% in equities in a lot of cases. I have a good friend of mine who retired back in 2014 from an investment bank. He'd been there for 17 years. And he tells me that his most successful year as an investment banker was in 2008, because he only lost 8%. And so that'll give you the gauge of how difficult it is to get through a recession. Now, 2008, 2009 was a very special recession, maybe even a depression. But these happen all the time. 1987 was a pretty drastic year, and an awful lot of capital destruction happened in that period. So it happens all the time. And it's how you react to it. So we're starting to recognize that there's risks in the economy. We need to slow down. And we need to really wait for high conviction trades. I still continue to believe in convergent monetary policy. It's taken a little bit longer, but we recognized about a month or so ago that the Federal Reserve would need to see some sort of damage or something happen, something break, in order for them to change course. And I think we're getting closer to that. We could have peaked out in the S&P 500, and we might be ready to roll over, and that might be the catalyst. If equities continue to rise, this is the fairy tale phase. This is where absolutely fundamentals don't matter, and we're at a new plateau, and this is where you do not want to be long, because this is the very end of the cycle. I don't think we're there just yet. I really do believe that we are on our way down to 2,500 before we push higher one last time into later next year, but we'll have to wait and see. So with that said, let's look for some sort of divergence here. We need to see some sort of RSI divergence. We need to see maybe a little bit of a rally up, a lower low put in, and then we buy the lower low on RSI divergence, provided that we have some sort of confirmation as a reversal in place. So it's unfortunate that we got stopped out, but that's why we have a systematic approach. We have a systematic approach so that we don't let our emotions overcome the trade, and in this environment, if you stick to this process, I can guarantee you it'll pay you massive dividends over time. So next we got the Canadian dollar, and as per last week's video, I did expect this to start pushing higher, and that's exactly what it's done. This was a little bit frustrating, and I've been talking about for the last couple of days to take a step away from the computer. Don't follow the charts during the day, and the Canadian dollar is the perfect example of why you shouldn't do that. If we go right into the 5-minute chart, you'll see massive drop here on, I think it was the GDP numbers, where it came in slightly better than expected, and it dropped. The problem is GDP is reporting domestic growth, and that's not what's driving it. I can guarantee you that the price of crude oil and commodities is a better driver or a better signal than any sort of domestic event, because what happens is when you sell something for US dollars, you take those US dollars and then you convert them back to your own currency, and that conversion drives the demand for local currency, to your domestic currency, higher, and that's why the Canadian dollar would rise on increased exports. However, that's not what happened. Crude oil actually went up yesterday, and the dollar actually strengthened across the board. So the dollar strengthened. I can make excuses up and say why it strengthened all the time. The dollar is strengthening, in my view, based on what's happening with tariffs and whatnot around the world. And so yesterday there was more tariffs imposed by the United States on Turkey. I think they doubled down. And I put risk on the system of $80 billion that might go bankrupt on. And that was exposure to, I think, Italian and Spanish banks. The problem is $80 billion, if they default on that, that's destruction of dollars, right? So the supply of dollars just shrank by $80 billion, and it drives the dollar higher. And in that environment, whether that happens or not, the market discounts that today for tomorrow. And if it doesn't happen in the future, if Turkey don't bankrupt or default on that debt, well, then the market realigns itself and the dollar will start to fall and factor back in that $80 billion. So that's why I think the dollar has been rising on the pretense that there was a destruction of dollars event. Now, when we look at the chart pattern, this broke down the perfect ABC, right? So I have an awful lot of conviction that this is going to continue to move higher, and it will be up around 134 where we should consider to short it. So ABC, if you guys have gone over the Elliott wave primers, A equals C, 2.39%, 2.39%, came into support, reversed higher. And so if we go out to the daily chart, what we see is 3, 3, and 3, where this is a W wave, broke up in 3, right? So that can't be a wave 1, meaning this cannot be a wave 3, meaning this is all corrective, and wherever we end, we should make a new low below this low over here. So I'm speculating that crude oil price will go up to $83 eventually, but we need to see 62 first, and that's why we want to get short up here, and we want to sit in this trade until it goes lower. So let's figure the pattern out from there. So 3 waves up for a W, 3 waves down for an X, 5 waves up here for an A, and then 3 waves down here for a B, meaning this has to be 5 waves because that A wave was up in 5 waves. So we got 1, 2, 3, very deep fourth wave, but nonetheless A and C are of equal proportion, and we should start to see this push higher. If you guys want to check out the commodities update as well, you'll see that crude oil actually looks like it's finishing off an ABC pattern, and it's got lower to go now. So in anticipation of lower levels, I think you'll see the dollar Canadian push higher. So the ultimate target to get short, 1.344443, right? That's just, we can round that off to 1.345. So for right now, Canadian dollar looks higher. It looks like it's going to continue pushing higher. And so that brings us over to our last currency pair, which is the dollar yen. And so the dollar yen, we're waiting in anticipation for 115, right? And 115 will be A and C of equal proportion. And this C wave needs to break up in 5. Why does it need to break up in 5? Because the A wave went up in 5, right? And so we're expecting 5, 3, and then 5 more. So if I'm to be worried about equities not breaking down like I expect, it would be based on this chart. And the reason being is because the dollar yen, there's a carry trade on where you can borrow money in Japan for next to nothing and invest in US assets and collect the premium on that. And so as you do that, capital flows into the United States, which has been doing up until now, driving bond yields lower. And in that environment, you see equity prices get pushed higher. And so as I look at the Japanese yen, I think this can push higher. And so we need to be very careful of our short position on equities, right? I think there might be a little bit further downside. We'll have a look at that in the equities spot. But ultimately, we need to be very careful. We need to look at alternative scenarios because this could be a liquidity driver in the short term. So 1, 2, 1, 2, 3, 4, 5 there for wave 3, A, B, C here for wave 4, and we should see 5 waves up. Nice RSI divergence here, and we've back tested perfectly the breakout. So this is, to me, it definitely looks like we've got some upside to come. And in this environment, although this is a very, very, very messy wave, we have to make it fit with the broader economy. Always look across the board and figure out where we're at to figure out where we're going to go in the future. And so, as I said, I got to be realistic with myself and say that 115, if we got to 115, that would be an area where I would consider to short this. Until we get there, it doesn't represent risk to reward for me, so I'm not very interested. So that's the dollar yen, guys, expecting more upside. Once we break above this area here, I think this could even be a buying opportunity. Nice RSI divergence, break above this overhead resistance, set your 2.5 times ATR down here, and this should be on its way to 115. But do recognize that this would be a tactical trade, and that would be for a couple of weeks, maybe even a couple of months before it starts to roll over. All right, so you'd be expecting to collect about 4% on the upside, but set your stop loss relative to that, right? So that's my view on the yen. I still think there's going to be more upside. 115 is a shorting opportunity. And with that said, that is the last currency that we have. If you guys have any questions, please do reach out. There's now a comments bar underneath the videos, which is excellent. So you guys can comment on these videos directly. and any input, any chart patterns. Maybe you guys see a different chart pattern, right? And that's why I wanted to teach you guys the Elliott Wave Primer, because maybe you look at this and recognize a different chart pattern. So please create a post in the forum. The more conversation and communication that we go through, the quicker you guys will learn, because you'll constantly question yourself. Or if somebody's questioning you, we always have that deep desire to be right. And I think that's a massive driver in our performance, right? To have somebody constantly question you and drive you to be better. And that's why I want this to be really more social, right? And so yeah, so don't feel like you guys are too new or you don't understand it fully. Everyone's welcome to comment, and I'm really looking forward to seeing what you guys bring to the table. I put a video out there about the equities, right? So you guys can read my PDF, and by the end of it, you will learn how to do these PDFs yourself. And you can get a feel for where we are in the economy. And so I gave you guys a small video. It's at the very bottom of the educational list, and it shows you how to find single equities in a very short period of time. And so go and look for equities that represents that view, and go through the whole process right now and figure out, okay, slowdown and growth, I want to be in staples or utilities, find a perfect company. Then use the Elliott Wave video, figure out the patterns on the chart, and then post it in the forum for everyone to see, and talk about your process, how you came to that decision and why you're in there, and the patterns that you see on the chart. The more of this practical experience that you get, the quicker you're going to pick it up. And then in 9 months' time, you're going to be fully autonomous, and I'm going to be going to you for advice and paying you. Right? And that's the idea at the end of it, that you guys are fully autonomous and you've got confidence in every single decision that you make. Forget about what anyone else thinks or what anyone else is doing. It's about what you're doing, and you have confidence in that. Because at the end of the day, we can have different views, but we'll still make money on our own views on the same assets, even if we're on different sides. It comes down to time horizon and expectation. So with that said, guys, have a wonderful day. And as I said, don't be shy to put views into the forum. Have a great day, everyone.